In business tonight, long-dated Japanese bond yields rose from three-week lows after demand for Japanese long-term debt fell to its lowest since July. That is, with a weak showing at today's 40-year bond auction. The weak appetite sending yields up across various tenors. Global investors will be watching for the central bank meeting next month, where it is expected to discuss changes to its tapering of debt purchases. Bank of Japan Governor Kazuo Ueda informed Parliament this morning that they are closely monitoring long-term yields, as these can also influence short-term yields. The weak bond auction earlier this month for 20-year notes had already sparked a rout in Japanese long-dated bonds, highlighting concerns about the country's finances. CNA's Roland Lim looks at what's driving the trend.
Now, this all started with a very bad bond auction. Last week, Japan's Ministry of Finance tried to sell about 500 billion yen worth of 40-year bonds. That's about $3.5 billion US. But the bid-to-cover ratio fell to just 2.2. Now, to put simply, bidders only offered about 2.2 times the amount on sale. And that's the lowest we've seen since July last year. Remember, anything under 3 is considered weak. And it happened right after the 40-year bond yield hit a record high of 3.675%, while the 30-year also spiked to 3.2%. Now, these are levels we've not seen before. Japanese bonds are usually seen as safe, so why is demand low? Well, 3 main reasons. First, the Bank of Japan, the biggest buyer of JGBs, has been tapering. In other words, slowly reducing their bond buying program since last year. So there's a vacuum left there. Secondly, the second biggest buyers, Japanese life insurers, pension funds, who usually love long-term bonds, well, they haven't stepped in. They're worried about rising yields, looking for shorter durations and better returns elsewhere. And thirdly, Japan's debt levels are massive. Now, we are talking about 200% of GDP. That's almost double that of the US, which currently sits at 124%. So, to reassure the bond market, the Finance Ministry has taken the rare step of sending out a survey to primary dealers and big bond buyers. The goal was to gauge how much demand actually exists for these ultra-long bonds. Sources say that this is a way to build consensus before making any formal move to reduce issuance. The markets have interpreted this as a sign that the government may cut super long bond issuance by up to 3 trillion yen. That's about $21 billion. Anything less, the markets see this as a half-hearted attempt to restore confidence.